In 2008, the world witnessed one of the worst financial crises in history. A collapse so massive that it shook the global economy, wiped out trillions of dollars, and changed the way people thought about money, risk, and trust. But how did it all begin? What went so wrong that the world's most powerful financial system came crashing down? Let's go back to the early 2000s. After the dot-com bubble burst and the 9/11 attacks, the U.S. economy was struggling. To boost growth, the Federal Reserve lowered interest rates to historic lows. Money became cheap to borrow. Banks started giving out more and more loans, especially in the housing sector. After all, everyone believed that real estate was a safe investment. Prices always went up, right? This belief led to a housing boom. People were buying homes they couldn't really afford, but it didn't seem to matter. Banks were happy to lend money because they weren't planning to hold on to those loans. Instead, they bundled thousands of home loans together into complex financial products called mortgage-backed securities, or MBS. These were sold to investors all around the world: pension funds, insurance companies, even foreign governments. Everyone wanted a piece of the booming U.S. housing market. On paper, it looked brilliant. Banks made profits by selling loans. Investors earned interest from homeowners paying their mortgages. The more people borrowed, the more everyone seemed to win. But underneath all this glitter, a time bomb was ticking. The problem was that many of those home loans were extremely risky. Banks were lending to people with poor credit histories, known as subprime borrowers. These were individuals who had little chance of repaying if things went wrong. But to make it look safe, financial institutions sliced and diced these loans into different tranches, some rated as safe, others risky. Ratings agencies, who were supposed to assess the risk honestly, gave many of these securities top grades, often AAA, as if they were almost risk-free. Why? Because they were making money too. The entire system was built on greed, optimism, and the illusion of safety. As long as housing prices kept rising, nobody cared. Even if someone couldn't pay their mortgage, they could just sell the house for a profit. But housing prices can't rise forever. By 2006, the market started to cool. People stopped buying, supply increased, and prices began to fall. Homeowners who had borrowed too much suddenly found themselves underwater. Their houses were worth less than the loans they owed. Many just stopped paying. This was the first crack in the system. When people defaulted on their mortgages, the cash flow into those mortgage-backed securities dried up. Investors stopped getting paid. Suddenly, financial institutions holding billions of dollars in these securities realized that their assets were worth far less than they thought. But the problem didn't stop there. Many banks had borrowed money themselves to buy even more of these securities, multiplying their exposure through leverage. The panic spread like wildfire. No one knew who was holding how much bad debt. Trust vanished overnight. Banks stopped lending to each other. Credit froze. The financial system, which runs on confidence, began to seize up. One of the first major casualties was Bear Stearns, an investment bank that had huge exposure to subprime assets. In March 2008, it collapsed and had to be rescued by J.P. Morgan Chase with government help. That was just the beginning. The biggest shock came a few months later, on September 15, 2008, when Lehman Brothers, one of the oldest and most respected investment banks, declared bankruptcy. It was the largest bankruptcy in U.S. history. The news sent shockwaves across the world. Stock markets plunged, investors panicked, and the global financial system nearly collapsed. After Lehman fell, fear gripped the entire economy. AIG, one of the world's largest insurance companies, was next. It had sold massive amounts of credit default swaps, a type of insurance for those risky mortgage securities. When the system started to fail, AIG couldn't pay up. The U.S. government had to step in with a bailout of over $180 billion to prevent total collapse. Within months, millions lost their jobs, their homes, and their savings. The crisis spread beyond the United States. Banks in Europe, Asia, and other regions had also invested heavily in American mortgage securities. The entire world economy went into recession. Trade slowed down, companies shut their doors, and unemployment soared. Governments had to take drastic actions. The U.S. government approved a massive $700 billion bailout plan called TARP, the Troubled Asset Relief Program, to inject capital into banks and stabilize the system. The Federal Reserve cut interest rates even further and started printing money through quantitative easing. Central banks around the world followed similar policies. Slowly, over the next few years, confidence began to return, but the scars of the crisis remained deep. Behind all the numbers and charts, the 2008 financial crisis was a story of human behavior: greed, fear, overconfidence, and denial. Bankers believed they were smarter than risk. Homeowners believed they could afford more than they really could. Regulators believed the market would take care of itself. And investors believed in a system that was far more fragile than it appeared. In the aftermath, there was widespread anger. How could the people responsible, the bankers, the executives, walk away with bonuses while ordinary people lost everything? Governments promised reforms. New regulations, like the Dodd-Frank Act, were introduced to make the system safer, to prevent such a crisis from happening again. Banks were required to hold more capital, and risky trading was restricted. But even today, some experts believe that the underlying issues, excessive risk-taking and financial complexity, never truly went away. The 2008 financial crisis changed the world in ways we still feel today. It reshaped politics, widened inequality, and gave rise to new movements and distrust towards big institutions. It taught us that even the most sophisticated systems can crumble if built on greed and illusion. So, when we ask, why did the 2008 financial crisis happen? The answer isn't just about bad loans or failing banks. It's about human nature, our endless hunger for more, our faith in rising markets, and our tendency to forget the lessons of the past. And perhaps that's the biggest warning the 2008 crisis left behind. When greed replaces caution, when profit outweighs prudence, and when everyone believes that the good times will never end, that's exactly when the crash begins.